Welcome to Real Estate Focus. I'm Calvin Law. Our discussion today is the major changes in the housing. My guest is David Snover. He is a senior loan officer from Mortgage Equity Partners. David has been in the residential lending business for roughly 25 years, and he is here today to share his expertise about some major changes in the housing. And I will discuss some changes in the compensation structure for the buyer's agent as well. So welcome, David.
Thank you. Nice to be here.
Thanks for coming back.
Yeah,
You are the
look forward
expertise
to it.
and the star of the show.
It's, a lot of changes. That's what life is.
It is. It's good to keep the consumers up to date, especially what's coming on August 17th.
You got that right.
So let's talk about it.
Yeah.
So in terms of the interest rates as of today, which is August 8th, 2024, what are the ranges in terms of the interest rates?
They've been trending down since the recent peak of November of last year, from about little over 8%, believe it or not, last November 23, to as low as 6.25% earlier this week on a conventional Fannie Freddie type loan. FHA rates are actually a little lower than that. They got as low as 5.875 Monday of this week. Ticked back up a little bit since Monday of this week. Today they're in the 6.5 range. The recent week we saw a noticeable drop. When I say noticeable, 1/4 to 3/8%, which is a lot in a few days, largely due to the Federal Reserve announcement last Wednesday that they're basically, without saying it outright, going to be cutting rates finally in September, whether it's 25 basis points or 50 basis points to what's called the Fed funds rate. That'll have an influence to driving rates down a little bit. That was Wednesday. Friday was the monthly jobs report. That came in worse than expected. That prompted rates to move a little lower. And then we have the Middle East crisis, unfortunately, and then we have fears of recession. So all that combined on Monday morning drove rates down, 3/8%, which was a lot. Since Monday, they've ticked back up a little bit, but the expression that I like to use, and many that are housing and economic experts, is the trend is your friend. As far as rates are concerned, rates have been trending down again since last November, almost 2%, without a Fed funds rate cut. So what that means is you don't have to have the Federal Reserve FOMC committee cut rates to have rates go down or go up. Or the bond market, which is the trading of mortgage-backed securities on Wall Street, bond traders, i.e. investors on Wall Street, they really are the barometer for the direction of mortgage rates. Mortgage rates, i.e. 30-year fixed mortgage rates, move almost in tandem with the 10-year Treasury. So the 10-year Treasury is the specific index that anyone wants to know where are rates going, where have they been, where might they continue to go. Just follow the 10-year. And the 10-year Treasury has gone from last November, when rates were over 8, it was around 5%, the 10-year. It dropped to 3.66 Monday morning. It's at about 3.95 today. So in 4 days, we've seen the 10-year go from 3.66 to 3.99 this morning. This is all just the trading of mortgage-backed securities. So that's where rates are today. Lower than they've been, trending lower, but you'll hear it's never in a straight line. It doesn't go like this, it doesn't go like this, and it doesn't go like this. It does this.
Just like a roller coaster.
It's like a graph, right? When
It
you,
is.
When you took your statistics class.
So I know you can't predict anything or you don't have a crystal ball, but based on what have you seen and also what have you heard, how many times that the Fed will cut the rate between now until December?
Well, that will be completely a fun. I'm of the opinion very strongly that there will be a rate cut in September. A rate cut of what's in question is whether it's 25 basis points or 50 basis points, i.e. quarter or 0.5%. That's pretty much going to happen. That's baked in. Everyone's saying that. The question after that, which would be, they meet every 6 weeks. So middle of September, the next one's probably like right around the 1st of November, right around the election. And then there's one more after that, right, which would be like mid-December. So there's 2 more meetings after September. It's really going to be a function of what the labor market does, because that's what the Federal Reserve is watching the most. The job loss, the initial jobless claim. So if there's one specific index to follow on a weekly basis, it's on Thursday morning, it's the initial jobless claims, which means people filing for unemployment for the first time. And as that continues to grow, unfortunately, you will see the Federal Reserve be more aggressive in their language and their decisions on future rate cuts. So I will say I'm of the opinion it's going to continue to worsen. The pace at which job losses accelerate between now and the end of the year, and that is revealed on a weekly basis, that it will determine how many and how much each rate cut. Many people are saying 3, 4 rate cuts before the end of the year, but forecasts are just that. They're forecasts. It's watching the week. It's kind of like everything else in life. It's day to day. It's, you know, what really is happening. It's the data you follow, not what people think is going to happen.
It's kind of fluid.
It's very fluid,
Right.
Absolutely.
And
The market is extremely volatile. I'm glad you reminded
is.
me of that. It is,
You look at the
in
stock
particular,
market. Yeah.
wicked volatile.
It's very volatile.
Yeah.
So pretty much the Fed has met their, I would say, requirements or criteria in terms of unemployment rate, which is like 4.5% at this point, roughly,
Well,
give and take.
That's depending on who you talk to. I mean, unemployment went from 4.1 to 4.3. There are many Fed members, like 16 of 19, that in a survey done I think a month or 2 ago said 4.1% is the highest. 16 of the 19 did not think the Fed unemployment rate, would exceed 4.1. It's 4.3. So guess what? They were wrong. So they have 2 mantras: maximum employment and stable prices. So inflation and labor, right? Well, inflation's been doing nothing but coming down. It's gone from headline over 9% to it's like 2.5, 2.6 now. So inflation, wage-based, wage growth inflation, coming down. Inflation is not the issue, it's labor. And that has been worsening. And the Federal Reserve, has had a very restrictive policy, and many people are verbalizing lately that it's been overly restrictive. They should have been cutting a lot longer. They should have been cutting a lot sooner, because, as I just said, rates have come down 2%, and they haven't even cut rates yet. Right. So I think the 5% is kind of they won't say it, but 5% is really their max unemployment rate that they would be okay with. So you'll see unemployment increase.
I think it's going to be trending towards that way.
Oh, it's
And
absolutely trending.
The rate of inflation continue to come down a bit, but we're still seeing a lot of expensive stuff. When you go to the supermarket.
Oh, sure.
Yeah, and also I think the retail sector might be coming down a little bit, but in terms of the food industry and stuff like that, still hasn't changed much.
Yeah, well, it's come down a little, but not as, yeah, I mean, certain segments, like everything, it's not, you know, that doesn't hit everything the same, everything, all products and services the exact same way. But the point is the way they measure inflation, that index has been coming down. And so
It's looking good.
that for relative to
recuts.
mortgage rates, it's very good.
Yeah.
And that is their mantra.
Right. Right.
That
That's
is-
what they want. So
well,
they
that's-
succeeded at some point
That's
or a
what
certain
they're-
way. So when it comes to buying a home, especially after most first-time home buyers gotten their pre-approval letter. Now, a lot of times where the loan officer told them not to change job, but some of them, you know, didn't listen or didn't follow the procedure, if you will, and they went ahead and switched jobs anyway. So why is it important not to have any lapse times or period of employment during the loan process?
You mean when they have a loan in process, when they have a home under agreement, and while the loan is being processed, they switch jobs? Is that the question?
Or before that, or during the pre-approval process?
Oh, in the pre-approval process? As long as if it's done, you know, against the advice of the mortgage professional, but the job is better than the last job, i.e. compensation's higher, makes sense kind of a move. It's not quite as stressful of a situation except for the timing, because what has to happen is when a person, let's just say shortly up to when they had a home under agreement, they were actually going to start a transaction, switch jobs. When you actually submit a file, when you have a home under agreement, you start a loan in process, you have to provide current documents, pay stubs, etc. Well, if you've just started a job last week and you put a home under agreement this week, you may not get paid till next week. And the underwriters require most recent 30-day pay stubs. So the contract dates may have to be extended to allow you to be in that job long enough to be able to submit pay stubs to underwriting to get that loan approved. So it becomes more of a timing issue, which sometimes sellers say, Mr. or Mrs. Buyer, you know, we wanted to close in 30 days. Now you need another 2 weeks because you switched jobs just before. That's not cool, you know. So it can complicate a transaction if you switch a job right up to when you shortly before you put a home under agreement, and definitely in the process of buying a home, if you actually have it under agreement and you're moving towards the close date and you decide to switch jobs, that would not be good.
Yeah, understood. So that's why most buyers should follow the...
They should. That's right. The advice of
The advice from
any
the
professional,
loan officer. Yes.
real estate attorney,
Yes.
real estate agent, real estate attorney, mortgage professional. I mean, it's a big deal. So it's an important process, and there's a contract, and there's performance, dates that they have to perform. I mean, you can lose money if you can put a lot of money at risk if you don't
Right.
pay attention.
And then we waste a lot of time and lost a lot of resources as well.
Exactly. 100%.
So lately, a lot of FHA loans going around. What are the changes that you see in FHA loans? Because some buyers are going for FHA loan for huge properties,
What's that?
over $1 million properties, and they're putting down like 3%. And most agents, they freaked out.
Well, yeah. All you know this from your experience of doing this, but FHA, just like conventional loans, the loan amount is limited by county. So, like in Essex and Middlesex and Norfolk and Suffolk, our Boston area type area, the FHA loan limit, I think, I should know this by heart, but it's in the 800s. So the loan amount, you wouldn't be buying probably $1 million property on a single family now. If it's a multifamily, those limits increase. I guess to say that the loan limits haven't changed. They change typically once a year for FHA and conventional. The minimum down payment for an FHA loan is 3.5%. So there really hasn't been any significant changes with FHA, and typically every year about 15%, less than 20% of all mortgages are FHA. So it's, it doesn't make up a giant segment of the transactions, but it's very much, because it's been around since the 1930s, it's 100 years almost, it's largely designed for low to moderate income borrowers. And those guidelines haven't really changed. What has changed, and I'm going to ask you this real quick so we don't run out of time, is the the NAR commission lawsuit. And I'll ask the question to say how are agents preparing for that change, because it's coming up next week. But what has changed on the lending side relative to the NAR settlement is VA loans haven't previously been allowed for the seller to pay for the buyer's commission. That is now being allowed. So that is a significant change on the lending side relative to the NAR settlement. The only other change, and you're going to speak to it, is buyers have to sign a contract if they want representation. But I wanted to ask you, how are you preparing as an agent for that NAR
that's a good
settlement?
question. So for those of you who haven't gotten the message yet, so that's why I'm here to share some of the new changes with potential buyers and sellers. On August 17 and after is the biggest change in the real estate industry or history in the housing industry, where before, between brokers, they can share the commission, such as listing agent can split the commission however they want with the buyer's agents. But after August 17, it's not going to be the case. Sellers have the options to either pay or compensate their listing agents and the buyer's agent directly, or the buyers, if you will. So those are the changes that will be happening as of August 17. So there won't be any broker compensation anymore. The buyers would have the option to either pay the buyer's agent or the buyers. And in turn, that's up to the buyers to either use the seller's concession. They're going to call it the seller's concession instead of call it compensation or real estate professional fee. It's up to the buyers to either use the seller's concession on the closing fee, credit, repair, or pay towards their buyer's agent. So those are the changes. So it's going to be seller pay directly to the buyer's agents, or compensate the buyers for their credit. So those are the two major changes right there. With that being said, especially first-time home buyers or any buyers who go out with their buyer's agents to look at the first piece of property, they must sign a buyer's agent's agreement first. And on the agreement, their terms and compensation structures between the buyers and the buyer's agent as well. So they must sign a buyer's agreement with the buyers before even buyers going out to look at any properties with their buyer's agent. So that is the DOJ's ruling that buyer's agent and their companies will have to follow as of August 17. Going forward is going to be the case.
Well, that's if they want representation.
If they want representation.
If they choose to buy a home without an agent, they can.
They can, but they can go
then
directly to the listing agents, where the listing agent would have to get permission from the seller and also get the consent from the buyer as well, so they can act as a dual agency. But it could be a slippery slope, if you will, because there may be some confidential information that the listing agent might not have disclosed, or intentionally not disclosing to the buyers. So it's going to be a slippery slope, if you will. So it's going to be a chaotic situation at the beginning. It's going to be messy, believe me.
It'll take a while to flush out for all.
It will be.
Between the buyer agent, the listing agent, the buyer, the seller, the lender. This will play out over 6 to 9 to 12 months before it really kind of settles.
Or longer, yeah. So
yeah,
it's
well,
gonna
I
be
mean, the changes
transition.
are permanent, but I think that
Right.
even on the lending side, outside of the change to formal change to the VA loans, because historically, for a VA veteran that was using a VA loan, the seller was not allowed to pay the buyer's commissions, or seller agent wasn't allowed to contribute to a buyer agent. That's allowed now.
Right. So the changes will be happening, no doubt.
Yeah, it's
so
important to be.
it's
know
gonna
they're
it's
coming.
gonna it's gonna get a lot of people, educated. Number one, number two, and get them accepted that hey, this is the new way of doing business now in real estate, whether they like it or not. So those are the major changes that happening soon. And in the MLS PIN, there will be no section where stated 2% or 3%. It's just with a section stating that seller's concession. But it's more like a firm remark instead of like a section where you can put a commission percentage into it.
Mm-hmm.
So with all the changes happening, compensations are up for negotiation now. So either new agents or seasoned agent like myself, we have to sharpen our negotiation skills, no doubt. So it's going to be like negotiations, between buyers and sellers and agents, going to be back and forth. So sellers will see a lot of offers with an amount or percentage of fee on it when they submit the offer, and it's going to be up to negotiation. So, however, the buyer's agent can get the commission either from the sellers or the buyers. So it's going to be interesting, and I'm learning too. Believe me, yeah.
We're doing a lot of work with real estate agents individually, as well as the broker owners, to help them prepare for the changes too, and relative to the lending side, with freshening up on what's called interested party contributions, IPCs, because IPCs are the seller concessions, because there are limits to those. If a buyer is putting less than 10% down, there's a maximum limit of 3%. And if it's between 10% to 25% down, it can be 6%. So for example, for your first time buyers that might be putting 6, 8, 9% down, and they're buying a $400,000 home, $12,000, 3 times $400,000, $12,000 is the maximum amount that is allowed as a interested party contribution seller concession. Typically, and you know this from being an agent, buyers' commissions, or the cost to a buyer to pay for the commission to work with the agent, in most cases, around here anyway, is 2 or 2.5%. So that 3% would cover that commission amount for that buyer and can be handled through the transaction. So it's helping real estate agents and broker owners to understand, the freshen up on the language of an interested party contribution, how to structure that language, how to present the options to the buyer. What we're hearing and seeing is a buyer sitting there and looking at Calvin, who wants to work with them as their buyer representative, to say, so what am I paying you for? So what are you doing for me again?
It's called value added. That's what the agents
and you
would have to
being
convey.
able to
Yes.
explain to them not only your negotiation skills you mentioned you got to bone up on, but it's like I got to be able to communicate my value to that buyer. Here's
why
what
I'm
you're
doing the
paying me
show.
for. Yeah, absolutely.
That's right. So yeah, it's gonna be a new trend, and a lot of agents would have to get themselves more educated
Or else.
than ever before
Or else they
to
won't be right.
earn their living. So
That's right, exactly.
so
Which
it's
is a
going to
good
be a
thing.
challenge. It's
Which
a good
is a
thing.
good
It's a
thing.
good thing.
It's all,
No.
these are all good things for buyers. I mean, it's healthy change.
Yeah, it is. And like I said, every change comes with goods and bads, right? So
Gotta work through it.
just depends on how you look at it.
That's right.
Right. So,
I agree.
well, David, thank you so much for being
Yeah,
here.
you're
And
welcome.
it's been
It's fun.
fun. And
Likewise.
thank you for sharing your expertise with the consumers. Well, I want to thank you for watching, and I hope that information that we just talked about would help you and educate you better when you're looking to sell or buy in real estate or getting a mortgage. So thank you for watching. I hope to see you next time. Take care.